Welcome to the Property Buyer Podcast. Join me, Rich Harvey, multi-award winning buyer's advocate and CEO of Property Buyer, where we explore the world of real estate and help you make informed decisions about buying or investing in residential and commercial property. Our show features expert interviews, market insights, and practical tips for navigating the complex world of real estate. Whether you're a first-home buyer, a seasoned investor, or simply curious about the property market, our podcast is for you. Join us as we share our knowledge and experience and help you achieve your property goals. Well, welcome again to another edition of the Property Buyer Podcast. My name is Rich Harvey, CEO and founder of Property Buyer. So with recent pauses in interest rates leading to an improvement in consumer sentiment, the property market appears to be stabilising and is getting set for quicker than expected recovery. My special guest today is Louis Christopher, Managing Director of SQM Research, one of the most accurate property forecasters in the country, with his regular boom and bust reports providing an excellent insight into the future of property markets right across Australia. So to help lift the lid on where the property market's headed, I've invited Louis to share his knowledge and experience on whether we've reached the bottom of the market, look at the key drivers of the market over the next few years, and discuss a bunch of other trends. We'll be discussing the legacy that COVID-19 has left, exploring the current rental crisis, potential solutions, and that perennial question, is now the right time to buy a property? So welcome, Louis. Thank you to...
Nice to be with you and your audience, Rich.
Thanks again. I usually start our podcast with a bit of a thought of the week, a bit of a philosophical kind of interaction. And this week I've got a great quote that's well known by the poet Robert Frost. He writes, "Two roads diverged into a wood, and I took the one less travelled by, and that has made all the difference." What do you think of that quote?
Oh, I agree with it all wholeheartedly. Look, if you want to build wealth, I strongly believe you've got to go out there and put a business together.
Yeah.
It's a path I've taken. I didn't initially take the path. I was an employee to begin with when I finished my uni degree. But in the end, I decided that I was better off having a go at putting a business together. I knew straight away I would have a lot more freedom in terms of my analysis, my research, and I knew it would be difficult, and it has been difficult, but persistence counts if you are going off for your own business. And SQM Research has now been alive since 2006, and we're now profitable. We've got 21 people. Fantastic. I started it from scratch. I own the business 100% still. Happy days on that front, but still a lot of work.
But hats off. I was relating to everything you were saying there, but hats off to you. Yeah, well done. That's a long time in business, isn't it? You know, since 2006. And
and I wouldn't say we've got the easiest country to do business in. There's a lot of regulations and so forth, but you've got to have a go. If you are aiming for good financial independence in life, and you want to do something you enjoy, then by all means go have a look at doing your own business. Yeah,
fantastic. Well, hats off to you. And look, you're very well regarded in the industry. You know, I get asked by journalists and other people all the time, who's the most accurate researcher? Whose advice should I trust? And your name is always top of my list, mate. So, hence the reason for chatting you today, and really keen to hear for your insights for our audience today. And just a reminder to all of our audience out there too, that if you do have a question, either for Louis or for myself or any of our other speakers, we have SpeakPipe on the website there. So you'll see a little microphone there. So if you do have a question, you can just speak into that, talk out your question, and we will endeavour to answer it in the next edition of our podcast. So Louis, just on that vein of starting your own business, what got you involved in property research in the first part? What sort of sparked your personal interest in property?
Well, I think actually it just started off as general investment research, and that came from my grandfather. So my grandparents actually raised me. I'm an orphan.
Wow.
And my mother passed away when I was 5. So very tough on them, of course. But nevertheless, my grandfather tried to teach me the way he viewed the world at the time, and he was an investor, a property investor. He was also an equities market investor, and he had an accounting background. And so I remember one of the very first things in life was him taking me down to the Sydney Stock Exchange and looking at all these brokers trading shares and yelling at each other, and I got a bit of a buzz out of that. And then the second thing he took me to was his investment property, and that was a very mixed thing for him, because he would earn income from it, but then occasionally he would have the very bad tenant. He actually tried to manage the property on his own.
Oh no.
Yeah, and he
error.
had it all. And so, yeah, I saw some times when he was doing it tough with that property, and the tenants didn't treat him too well at all. So I think there was always this interest in investment markets right from scratch, and then there was just the personal experiences. And one of the reasons why I got myself involved in property research was that I was always very keen to just make sure that the information out there was objective and as free from conflict as possible. And the reason why I had that was the second experience I had in life, which wasn't a pleasant experience. We learn from our
you learn more from your mistakes than your successes.
You do,
right? Yeah.
But this was nasty because I mentioned I was raised by my grandparents. Yeah. So after my grandfather passed away, I was living with my grandmother, and there was an investment property on the Gold Coast. My grandmother felt the need to sell the property after my grandfather died, just to have a bit of cash. The property manager that was looking after that one took advantage of the situation, took advantage of her lack of knowledge on the housing market. I know I was still young at the time. What was I? I was about 12, 13. But I could see what was happening, but yet I was too young to be able to sort it out.
You couldn't intervene, yeah.
So she got ripped off on the sales
Yeah.
by about 40%, I worked out. Wow. Yeah, it was bad. It was really bad. This guy didn't help trying to sell it. It was in a holiday apartment complex. And I think going through that experience really marked me. And I always thought, well, if she had better information, more objective information, that wouldn't have happened.
It's interesting. A similar story. My brother also bought a property on the Gold Coast, Hope Island, and he got sucked in by the White Shoe Brigade of the day. Remember, they'd fly you up and say, we've only got one or two of these left. There's other buyers. You've got to sign it, and it'll be gone by Monday. And fell for that trap. And anyway, again, probably overpaid by 20% too much. And again, it was before I started my business, so he didn't come to me for advice. But again, it gets up your goat, doesn't it?
It does.
Seeing people ripped off, not making good decisions with the right kind of advisors around them.
Correct, and it's just sad. I mean, it does still happen today. Not probably as much as what had in the 80s and the 90s when there was less information out there, but I know it still happens, and it's extraordinarily sad and it's criminal. I mean, we all hate to be the thought of maybe being ripped off by a car mechanic or when we're putting our car in.
That's it,
right? And it's only because we don't have the proper knowledge about how the car works. So people on the investment side should consider that we're dealing with mums and dads, real people. And just because they don't have the knowledge that you do doesn't mean that gives you the right to rip them off.
Exactly right. Yeah. So, I mean, it comes back to, making sure your advisors are appropriately accredited. I'm a QPIA, a Qualified Property Investment Advisor. I'm a member of REBA, the Property Professionals Association. But I'm curious to know a bit more about your background. So what did you study at uni? Did you do something to get into property?
So, when I was doing my HSC, I had a pretty tough time growing up because my grandparents were raising me. They were sick as well, and they passed on early. So when I was doing my HSC, I really had no idea what I wanted to do and did not believe in myself. That was a big thing. I just had no self-confidence whatsoever. After I left school, it started to build. I started to really get the direction that I wanted, which was somewhere in investing. And I thought at first I would follow my grandfather's path and be an accountant. And so I did an accounting degree. The second year into the accounting degree, I realised I didn't want to be an accountant. But I loved investing. I still loved investment markets. The third year of my degree was the first year I bought an investment property on my own bat.
Good on you.
I bought a commercial property, funnily enough, up on the Gold Coast once more.
Yeah.
It was a warehouse sheds, like 5 sheds together, that were all under the one lot. And so I managed to convince a bank to lend me $500,000 to do that while I was still at uni. So I gave them a business plan, the whole lot. Many financial institutions knocked me back, but this one bank took me on.
What LVR did you get on that? That's amazing.
The LVR on it was like about 97%, and it was commercial.
Fantastic.
Right? But the reason why I was interested in it was, and why the numbers worked, because it was selling on a net yield of 12%, and you could borrow the money at the time at 8%.
Fantastic.
So straight away it was cash flow positive, but I certainly got a lot of experience out there. I had 5 different tenants. They were all blokes in their 50s, and the biggest mistake I made with that property was turning up with my full fledged of hair. I had hair back that time, Rich. I soon lost it after that experience. So
sounds like me.
And they straight away stopped paying the rent.
Yeah, geez.
So I was. That was a very difficult situation because they thought they could take advantage of this young bloke. And that's when I toughened up a bit more, and I got to the point where I had to lock out one of these blokes. And that was very full on for, at the time, I think I was 22.
Good on you. Yeah.
To take that on.
Yeah.
And look, I didn't make a lot of money on that property. I eventually sold. I shouldn't have sold. There's one other things I think we talk about, some of the advice you take. Well, one of my pieces of advice is hold on to your property if you can.
Yeah.
They generally work out. Sometimes you've got to let duds go though.
Yeah.
But I should have held on to that property longer.
Yeah.
But
great story. Yeah.
Yeah,
That's
so
a real
look,
baptism of fire.
I
wasn't
think
it?
that's the story here. This is baptism of fire at the
Yeah.
very beginning. The personal experiences with what my grandparents went through.
Yeah.
My own personal experience.
Yeah.
Fending for myself. I had to fend for myself at a very early age, and I think that's what led me down the path of getting my own business.
Yeah.
Because there is that relationship there when if you fend for yourself early on in life, you tend to do that the whole way through.
Good on you. Now, you've been known as quite an accurate forecaster of the property market. You've got the boom and bust report right there in front of you, and I'm curious to know a little bit more about, if you can share, what your secret is. What's your sort of tactics? How do you and your team stay on top of the property market to come up with these amazing projections every year that are pretty much on the money?
Well, one of the key ingredients is the data. So we sell data, as you know, we sell information. And as you've heard from the story today, the information is important to me. And objective information is important. So having really good information helps. The other factor which I think helps with property over and above, say, equities, and by the way, SQN Research now covers all asset classes, but we're known for property, as you know, is the fact that when it comes to the property market, it trends more, right? So it's more cyclical. Compared it to the equities market, where it's choppy, you don't know where the equities market is going to be a week from now.
Yeah.
But I think we'll have a pretty good idea where the housing market's going to be a week from now, right? Because it trends better. So that helps with the forecasting. I have a personal love for economics as well, and you'll note, Rich, that when I do the forecasting, I tend to focus at the macro level, at the capital cities.
Yeah.
I don't attempt to try and focus or forecast on an individual street. It's not like that. We have information at the street level, no problem. But if you want to try and capture the turning points in the market, they're more often than not driven by macro factors. Interest rates, population growth, employment growth. All these factors matter. What the government is doing in terms of first-time owner grants, how's the supply side actually trending at this point in time, that all factors in. And when the market does normally trade on, say, interest rates, the economy, as opposed to, say, COVID or something that's really left field, it makes my life easier as a forecast. And I think that's one of the reasons why this year, so far the forecasts are coming in nicely. But when we first had COVID hit, that was a very difficult one to work out what was going to happen.
I remember doing a webinar, I think it was with another researcher at the time, and we had a record number of 750 registrations for a webinar when COVID, it was discussing what will be the impact of COVID, because everybody was conjecturing, the banks were saying potentially a 30% drop, and this is going to happen, and that's going to happen, and there was all this doom and gloom out there.
There was, and look, there was a possibility that the market could have crashed if the government didn't intervene into the economy.
True.
And we just didn't know whether they had the ammunition to intervene or intervene enough. Now they did intervene in quite a lot, and that saved the housing market. But we just didn't know at the time. And you may recall initially the market did start to fall.
I remember there was 2 months there where we were panicking as a business, like a lot of businesses. Everyone just closed up shop and the consumers went to ground. They did nothing. Everyone was freaking out going, what will happen? I was telling all my clients, this is fantastic. This is an absolute godsend from heaven, manna from heaven, because you can now go and negotiate the pants off this property. Yeah. And we got some amazing buys. There was about a 2-month period where I just went and smashed out some deals for our clients. It was one of the best years ever. So very, very few windows of opportunity there to get that. But talking of COVID, we've seen quite a few changes and trends come from COVID, Louis. I think, but my question is, what are the trends that you think are here permanently because of COVID, like work from home, flight to the regions, home offices? Like, are there any particular trends you think are going to be here long term that are now being cemented in the industry?
You know, Rich, I'm not sure any of it's going to be permanent. And I've thought about this a lot. And initially I thought, okay, perhaps the regional living, perhaps the living in larger properties is going to be permanent, but I'm not so sure now. Our data is showing a big flow back from the regions back into the cities. What's driving that? Potentially employers demanding their workforce be back in the office, like I have with my team, right? We're back here, we need to collaborate, we need to talk more. And you miss something on Zoom.
You do. It's not the same, is it?
It's not the same. And now we've just heard from National Australia Bank, they're now asking their workforce to be back 5 days a week.
Wow.
So it is flowing back, and we are now recording higher rental vacancy rates in the regions. We've all talked about the rental crisis, agreed, it's there. But on the very tipping edge of the information right now, rental vacancy rates are now rising in the regions, and asking prices, which we like to follow closely, are now falling in a number of these regions, which absolutely took off during COVID. So we're seeing this reversal now. Yeah. So I'm not so sure whether any of this is going to be permanent, Rich. I'm just really not.
So it's that mean reversion, if you want to use that.
It's a mean reversion. I mean, look, maybe the notion of living in larger properties, but that's a lifestyle thing. I mean, everybody wants to live in a nice big property and have plenty of privacy. I mean, the rich, the wealthy want large properties, right? It's privacy. That's the benefits and privilege of being wealthy. People go for that. But I think the realities of the city rental crisis will mean that we'll see the number of occupiers per property increase again. So that will reverse out as well. There was a big expansion in housing formation due to people looking for larger properties. So I'm struggling to see how any of this is going to be permanent.
Well, that just sort of comes back to that point you made about data, that we're going to be seeing a whole range of different data sets moving at any one time, and trying to make a decision in isolation on one particular data set's not helpful. You've got to look at it all.
You've got to look at it all, but I think one of the other points you want to talk about today is how easy is it for users of data out there in the marketplace of all the conflicting media out there, and really the conflicting information that's out there. Where I'm well aware we're not the sole data provider out there. I'm competing a lot with CoreLogic. I'm competing a lot with Domain. And it's not easy. They've got the media with them, we've now got PropTrack, and look, I know the people behind PropTrack. I respect those people there. Cam's a good guy. He's a very good analyst. But nevertheless, from a user's perspective, it must be very difficult right now with the conflicting information out there, and hence the reason why we get so many conflicting media stories, because the data providers can often tell a different story.
You can spin it whatever way you like, right?
You can. That's it, though. I think every data provider's been on board with what's been going on with the rental crisis. So we've picked that well and truly before the Australian Bureau of Statistics did. And I think we're picking the bottom in the market now.
Yeah. So let's come back to this sort of question around the bottom of the market. So we've seen the property market contract, fairly sharply as a result of 10 consecutive rate rises, and today soon there'll be another announcement whether it's on pause or one more rise. But we're seeing a turnaround in sentiment, but the reason for the pause last month in April has given rise to a uptick in consumer sentiment. I think it was 9 points on the Westpac Melbourne Institute Index the other day. But tell me, what are the signals that we've reached the bottom of the market, and do you believe we have reached the bottom of the market?
I think the bottom was in the Sydney and Melbourne market as early as late February. So we started to note that the new property season, which essentially started in February, started with a strong rise in auction clearance rates. And I think there was an anticipation by would-be buyers that the cash rate would go on hold soon. But that in itself is not the reason why the market is rising, when, as I'm sure you're well aware, often in the past it's taken an interest rate cut before we see real activity in the marketplace. So what is different about this cycle, which has meant that the market's bottoming and actually rising even while we haven't had a cut in interest rates, and interest rates are well and truly off their lows? Well, it's a lot to do with inflation. And what I mean by that, on the ground, the rapid rise in rents in the cities has contributed to many would-be renters turning themselves into home buyers. Many property investors staying in the market as well. You'll note that, of course, on our numbers as well as CoreLogic's, nobody's recorded any substantial rise in listings in the downturn. And normally for normal downturns, you get a rise in listings because there's not that much sales turnover, and so vendors are increasingly competing with each other, and days of market blows out.
We're not seeing that at all. I mean, the thing is, Mike, you talk to my team, and their biggest challenge every week is there's just not enough on the market. There's just not enough on the market. You know, like CoreLogic numbers show we're 25%, 30% down on the 5-year averages. So the lack of listings is really crimping supply.
Well, we've just reported today, so SQM Research reported for the month of April that new listings were down by another 20%.
Wow, yeah.
And old listings, the old stock's now starting to fall. And that's telling me absorption rates are also rising if old stock's finally moving. So
when are we going to see listings rise? I mean, that's the thing. Are we going to see? Are we just going to be on struggle? You know, in the struggle street in terms of listing volumes for quite some time?
I think we will when the market really heads into a strong recovery. Vendors don't like selling in downturns, and they certainly don't like selling at the bottom of the market. Some vendors will, though. Some vendors don't believe that we're at the bottom of the market, so there'll always be vendors. But on turning points in the market, you generally will find that volumes are pretty light because vendors are starting to see it for what it is, and no one likes to sell at the bottom. So I think when the market picks up a bit, you will start to see more vendors enter into the market. They've been pretty quiet in the downturn. They haven't been forced to sell, but many would like to sell, of course. It's just the price has got to be right. And of course, they've been through a bit of a price adjustment. Asking prices did fall last year, but not massively so. So I think we will see a bit of a pickup in listings perhaps in the second half of the year. So any real estate agents listening to your podcast, they might be a bit happy about that news.
Get excited,
because I know many agents have been doing it tough. But in terms of prices, why are we seeing rising prices even though interest rates are high? I've mentioned inflation. Here's a key fact that I don't think too many people are aware, especially for the Sydney housing market. In the 1970s, Sydney house prices in that decade didn't just double, they didn't just triple, they quadrupled. They went up fourfold in 10 years. That's in nominal terms. Now, one of the prime reasons why they did that was because we had high inflation.
Oil price shocks, I remember, in the 70s.
Oil price shocks, supply shocks, and people were looking for a hedge against inflation. And property has always been a good hedge against inflation, always, because it's real, it's tangible, it's not paper money, it's not fiat money. And so it rises, and this is exactly what we're seeing now. We also, with that, we're seeing a rapid rise in the population. So we know the current population growth rate in Australia is 2.3% per annum. That is the highest of any OECD country at this point in time by far. The next highest would be coming at about 2%. And the average is like under 1% for OECD nations. So we're rapidly expanding as a country, and we're expanding way and above and beyond the supply side. And look, I have personal concerns about that. I don't know whether we should be expanding as quickly as we are. I mean, it's great in terms of making money, but we have got a real rental crisis on our hands here, and people are getting angry.
Well, it's interesting. Let's just jump to that question, because the rental market is one of the tightest I've ever seen in my career. I've never seen, Adelaide's 0.3 or 0.5%, Brisbane's 0.7,
Yeah.
Sydney's 1%, whatever the number is
Yeah.
at the moment. It's ridiculous. So I'm predicting the rental crisis is going to get worse. I'm predicting myself, tell me if I'm wrong, but I think rents are going to go 15% this year in Sydney.
Our national forecast was 12 to 15%, and we had a high double digit again for Sydney.
Yeah.
And that's after rents over the last 12 months on our numbers
Yeah.
in Sydney have gone up 25%.
Wow. So do you foresee the rental crisis again getting worse this year and next year? Like when's it going to resolve?
For the cities, yes. For the regions, no, it's getting better because of this flow back from the regions. So if one is in a position to go to live in the regions, do it because it's now starting to free up. But for the cities, it's not good at all. The truth is when it comes to overseas visitors, Sydney and Melbourne are their first ports of call. The other truth is that due to the rise in interest rates, building approvals have sunk badly. So the approval rate now is about 40,000 dwellings nationally a quarter, right? So that's 160,000 dwellings approved a year, and not everything approved is built. The HIA, Housing Industry Association, is currently reporting a 30% cancellation rate on new projects. So let's work this out. 160,000, take off 30% of that, we're looking at somewhere along the lines of about 110,000 dwellings in the pipeline.
And we need 190, right? To satisfy demand approximately?
Right now, with the forecast for over 400,000 visitors, plus some natural bursts over deaths, that means for the next 12 months, we'll see population expand by some 500,000. The average persons per dwelling is about 2.5. Now going up a bit. So we need about 250,000, 240,000. We're not going to build it. It's not there. It's a mathematical certainty, given that population expansion and what's in the pipeline for supply, that we're going to have an even worse critical shortage on our hands. And what I'm worried about with all this, Rich, is that decision makers on all this, federal government, state government, are going to be making the wrong decisions that potentially could make this whole situation even worse.
Yeah, particularly the Greens. Put a cap on rents and
put a cap on rents.
And just, oh my goodness.
They're not thinking, they don't look, who's their economic advisor on this, right? Look, the first thing that will happen if you freeze rents, and I think it's happening now, is that investors want to walk away.
Same with tinkering with negative gearing. I mean, they got obliterated in the polls for that last time, but that's the worst thing. I mean, BTR, build to rent, is not a silver bullet, but a little bit of a drop in the ocean for satisfying some demand.
That's right, and it is coming. Build to rent is coming. I mean, the federal government has announced a withholding tax
15%
discount.
instead of 30%.
30 and 15%. So, and from the other side of our business, we actually rate fund managers. So we know that there's fund manager interest in this, and particularly from the super funds. But the issue with this is it's not going to happen tomorrow.
No.
It's
supply from three to 4 years away before you get the approval, you get the investment in, you get the thing built, and there's always delays in building. Like everything takes time, right?
Correct. Yet we've got the problem right now. So I'm concerned. And how will this manifest itself? Well, I can tell you that the community is going to get angry. And how they'll take that out, I'm not sure. We know that there's now a rise in tents in the south of the city here in Sydney. It's happening in Melbourne as well.
Well, you just got to look at the charities. Like, you know, I do the Vinnie's sleep out usually every year to try and raise money for the homeless. And, they're trying to raise $9 million this year. But, according to all the charities, there's an influx of people getting cost of living pressures, and it's really affecting people that are really got limited incomes to try and cope with higher rents. It's a massive problem.
Correct. So what can we do now? What is it? Look, we know we need to ramp up supply, but it's not going to happen in the next 12 months.
It's for me. It's maintaining the right incentives to get mum and dad investors and institutional investors back into the market. Secondly, it's planning. It's around getting quicker planning approvals, particularly in medium density, which has been talked about till the cows come home, but not implemented. Remember, the Sydney Council's all rejected that missing middle report. That's a couple of things they can do straight away.
I will add to that, and I know not everybody's going to agree on this podcast, is we need to look at migration for now. And I'm not saying we cut it permanently, but we consider managing migration for the current economic times. There is a time where we ramp up migration. Perhaps there's a time when you slow it down a bit as well, right? So we need to consider that is something we can do now.
Yeah, that's it. So tell me more about, Louis, your view of the market in each of the capital cities. Where are we going to be heading, given all these scenarios happening in each capital city? Can you give us a bit of a snapshot? Where are we looking at for next year, 2023 and next year?
So for our forecast of 2023, we released these in November. We believe that Sydney would drive the housing recovery. Our forecast was that Sydney dwelling prices would rise between 5 to 9% this year. There was one key assumption with this, and that was the cash rate had to stay below 4%. And it's looking more promising by the day. That's what's going to play out. The city which we were most bullish on was Perth, the city of Perth. So we had a forecast of 4 to 8% for that city. And Melbourne, look, we weren't as bullish. We had it up 1 to 5%. And Brisbane, we also had Brisbane up 1 to 5%, and with Adelaide, we had it steady to up 5%. The one city which we're still a little bit negative on is Canberra, where our forecast was -3 to maybe +2% if all goes well, but we're not so sure all is going well there. So the overall forecast nationwide was for dwelling prices to rise by 3 to 7%, and as mentioned, driven by Sydney.
Interesting. I noticed all the bank economists are rapidly adjusting their forecasts over the last couple of weeks. I know CBA came out yesterday and basically said, I think 3 to 5% or 3% this year, 5% next year, something like that.
Yeah, they were at one stage of this year down 15%, I think.
That's right, yeah. And same for Westpac, they came out sort of talking about a slight increase this year and a 5% increase.
And I think ANZ moved the previous week as well. So I think that most of the ANZ the banking forecasters have moved. Their track record has not been the best. In recent years.
Yeah. ANZ did tend to, I remember years ago when I used to do my presentations, they tend to track the undersupply situation pretty well. I don't know if you remember their charts, but they were pretty good at that. But I think it was sort of about between 2015 and 2018, we sort of played catch up. We actually got a lot of properties built in those years and the undersupply situations are fixed up. But now we're heading back into this major structural decline again in number of volumes of properties being built. So it's an interesting scenario. So a couple of other questions for you, Louis. I want to talk about the key drivers of the market, perhaps over the next 2 years. Obviously, migration is going to be a major factor, but what do you think is going to drive our property market considerably the next 2 years?
Well, I'm not expecting a slowdown in rents over the next 12 months at least. Maybe the second year we might get it for the capital cities. As mentioned, we're more negative on regional Australia, just due to this flow back to the capital cities. So that's one area where we're more concerned about. I think what's going to drive the market overall for the next 2 years, yes, we've talked about migration. We've talked about the shortage of real estate. Interest rates will definitely drive it. There is the potential here where if we have a new outbreak of inflation, the RBA panics and they aggressively lift interest rates. That's what ultimately happened in the 1970s. There were recessions during that decade. So we need to be watchful of that. I think the RBA and others are hoping that we've now through the worst of inflation by the mere fact that we've got global commodity prices coming back down again. You may be well aware of what happened to lumber prices and what that meant for builders in this country. It's all come right down. So that helps with the inflation outlook.
I know firsthand about that, about the cost of that, because I'm building a townhouse at the moment and it's gone up by about 20 to 30% than what I expected it to be. But it is what it is. But the intrinsic value of the property is certainly increased over that time as well. So yeah. What was I going to ask you? Take a second, we'll just edit that out.
Sorry.
All good, mate. We could just edit all that out. So.
Okay, no. Went down the wrong way.
All good. So Louis, I want to just ask you about the media as well. We talked about this at the start, that they often create a conflicting picture of what's happening in the reality. So how does one, the average Joe, the average buyer out there, interpret what is said in the media and make a decision on what to do in the market?
Well, I think people need to understand the motivations behind the media. How does the media get eyes? How do they attract readership? Well, by putting out alarming stories, by focusing on your fears. Okay, that's how they get your attention. It's pretty simple stuff in many respects. Now that said, though, there are very many reporters out there which I do respect, and they just call it straight. There's no question about that. But just keep in mind, every day they're looking for a story. They need to come up with a story every day. Okay, and they are also aware that all eyes are on real estate. They always have been and always will be. So this is the reason why you will see one day a story that, yep, housing market's getting stronger, and then almost the very next day, almost by the same masthead, housing market's getting weaker. Right? It does happen. Yeah. And often they are opinion pieces, so just keep that in mind. But it can also be just conflicting data that's come out. So I think for the average person out there, don't get too hooked up about these stories, but do focus on the big drivers that can drive the market. So what are interest rates doing? What's unemployment doing? And above all, if you are buying into the market, buy within your budget. That's really important. That just ensures that, okay, in a worst case scenario for the economy where we go into recession, you can get through. It's about getting through. It really is, and playing a longer term game, not necessarily trying to leverage yourself up to the max where just the slightest thing goes wrong in the economy and you're in a lot of trouble.
Yeah, I'm a big believer in having buffers, Louis. You've got to have buffers. You've got to be conservative in your approach. Like if the agent tells you get $800 a week, work it on $750, for example.
That's right. I think in this too, look, property is not about getting rich overnight. No. It's playing a long-term game. And, life and career and wealth, I believe it's not a sprint, it's a marathon. Yeah. And that's how you play it, and that's how you survive. It's about surviving in particular.
So just on that, we obviously work with buyers in residential and commercial, and we also find sites for developers, but purely on the buy side. And we're helping our clients to interpret the market, basically take some of your data, take where the market is at, and then we have to apply it at a very localised level to help guide our clients' decision making.
Yes.
So how should buyers approach the market right now? We're now in sort of May 2023. Often people say it's not wise to try and pick the bottom of the market, and we know that's in the rear view mirror now. But how should buyers approach this market if they're thinking about buying? Do you think it is, and when do you think is the best time to buy?
Well, the best time to buy is when it's appropriate for that individual person, ensuring that their personal financial circumstances line up. And depending on what you buy, like buying a family home, you shouldn't necessarily overly try to time that. You should time what's going on with your personal life. So, look, I've always been a great believer there's no grand rush into anything. But nevertheless, take into account the information at hand, and I do believe the market is rising from here unless we see the RBA panic and they aggressively lift rates. I think the probabilities of that are unlikely, and certainly the money markets are not pricing that in, but it still remains a possibility that inflation breaks out on the surprise upside again, and then they have to do something. But failing that, housing prices are definitely going to rise from here in the capital cities. And I say that because we've talked about this issue surrounding massive increases in underlying demand driven by a population explosion, and at the same time, supply being heavily restricted, more so than normal, because of the recent rises in interest rates and what's happened to builders. So there's a real squeeze on the market. We're seeing it in the rental market. And it will flow into the for sale market. That I'm very confident about.
You did some analysis, I believe. I read an article yesterday, that if interest rates do get to 4% cash rate, there is going to be significant pain. But if the market does go to that, I think you're right. I think we will see pain. But how much over the 4% are we going to see pain? Is it just a couple of rises over the 4, or is it well into the 4s? Where do you see the pain point being?
So where we got this 4% from, and this takes us back to early November last year when we completed some of our research ahead of our forecast of 2023. So I was very curious to understand the magnitude of this great fixed to variable mortgage reset and what does it mean. And fortunately, since we rate and research a number of non-bank financial institutions, and we've got some good contacts with the banking sector, we were able to go out there and survey, let's say, lending book managers in terms of where they believe their lending book would suffer, where they would start to see some real cracks on their book, where their borrowers would have to be in a position to forcibly sell. And the feedback we had was cash rate. Some said high threes. You'd start to see that on their book. Some said low fours, some said high fours. This is a cash rate we're speaking of. And so we believed then, okay, well, it looks like a cash rate of about 4% is where the RBA could take it to. But if they start going over that, then we will start to see forced sales.
Yep.
And so far, we haven't seen forced sales. This is the interesting thing. I think people were expecting to see a lot more forced sales, but we measure this. We've got a distressed properties index. At the moment, we're recording about 6,000 distressed properties in the market, and that's out of about 230,000 listings.
So it's still very manageable. I mean, I talk to a lot of agents and I say, look, have you got any potential listings coming up that, where the owner's pretty desperate to sell? They go, no. I said, get inquiries from people going, look, the mortgage is uncomfortable, but it's not forcing them to sell.
Yeah.
So I think that's going to be the
Well,
status
prior
quo
to
from
COVID, Rich, we were recording about 13,000 properties selling under distressed conditions. So we're well and truly below where we were prior to COVID.
That's half, yeah, okay. I've got two more questions for you, Louis, before you're off the hook. I'd love to hear a little bit of a personal favourite property story, something that's maybe interesting. I know you shared the commercial property at the beginning, but is there anything else that you can share with our listeners just to kind of give us a little bit of an insight into your passion about property and buying something?
I think a more recent one, relatively recent one, I guess, was it's no longer recent, but just buying the family home with my wife, which I did during the GFC, 2008, when the home lending rate, you recall, was about 9.75%. And we didn't buy anything too big because I wanted to get SQN research going. So we bought within the means where I knew, okay, I wouldn't have to go off and get another job. I can manage this mortgage. We bought that property, when was it? August that year. And there was a bit of timing involved. I couldn't help myself, because I looked at the money markets and it was pretty clear the money markets were forecasting deep cuts in interest rates, even though they hadn't happened yet. So we bought it. We bought here in Sydney. We bought in Thornlea, if you know Thornlea.
Yeah, and I used to live in Pennant Hills. So
That's right. So we bought this block of land, flat block of land, 930 square metres,
Fantastic.
4-bedroom house, and the price was just $650,000.
Brilliant.
It was a great buy. We really did well.
Yeah.
And then sure enough, they cut rates.
Yeah.
And the market took off. Anyway, we did a reno on that, and we've recently upgraded. We sold that property. Once again, shouldn't have sold it, right? Don't sell Sydney property. That's my firm piece of advice. Don't sell it, but we did to upgrade, and we sold that for 1.55.
Good on you.
Yeah, so
Brilliant.
we put about $220,000 of renos into it.
Well done. Yeah.
So it was a good buy. It was a
Yeah.
good home.
Yeah.
And look, where we're in a nice home now. But
you had a goal, you had a plan, you
Yeah.
set your intention, you added value, you did all the right things. So
Well, that's it, and I think that's the thing for younger people. And I get quite concerned when I see these surveys saying young people have given up hope in buying a property. That's crap. All right, look, I can point out stories back to the 1960s where people said, "Oh, yeah, it's all too hard for young people." You got to build your career or get a business going, build an income, build a platform, work hard at it. It does come. And I'm not saying it's easy, and especially not in Sydney. We know that, and absolutely true. And yeah, I got a great price at $650, no question.
Yeah.
But it was all the lead up to it. I certainly wasn't on the income I am in now. Then I was on a lot lower income. So it can be done, and I would just suggest that no, it will work out, provided you work. It will work out, and for young people listening in, I guarantee you will get into market if you really want it enough. It'll happen.
Brilliant. I'm going to be sharing this podcast with my two sons that are getting married this year, and I'm trying to get them into the property market as well, and saying, look, just set a deposit aside, save up for it, and get into the market. It's a great financial discipline, because Otherwise, you spend your money on jet skis or some other kind of, depreciable asset.
Well, that's exactly right. And they may be cheap and they may give you some instant pleasure, but ultimately it will boil down to that. You think of your whole life and think about where you want to be when you get to your 40s and your 50s.
Yeah, brilliant. So look, Louis, you've already shared your best piece of investment advice. Don't sell real estate. So I wholeheartedly endorse that.
Well, I got a few other ones as well. Like,
tell me some more.
Okay, be careful with off the plan.
Right.
Great. I've noticed for more people than not, it hasn't worked out. Yeah. Corner blocks. I'm not so sure about corner blocks, Rich. You might have a view on that, but the corner blocks I've come across, yes, you can subdivide them, but they're not that pleasant to live on. I believe that there's actually a relationship between crime and corner blocks being hit a little bit more. So I'd say be careful about that. Units, look, we're talking about off the plan. Units can work. I generally prefer freehold over strata because sometimes you can have problems with strata. But I've got a property at the moment up in Queensland. It's a strata property and it's working out well. Body corporate's actually very good and everybody's on board working together, no problem. So they can work nicely and that property's doing rather well. I generally do prefer freehold if it can be done, but I more than understand people just trying to get on the ladder as well.
Brilliant. Well, Louis, thank you so much. Louis Christopher, Managing Director, SQM, thank you so much for your advice. Some really great value there for our listeners today. And look, if you do have questions, as I said, click on the speak pipe there on the website and you can just talk your question and we'll try to answer that next episode. But until next time, I'm Rich Harvey, CEO of Property Buyer. Thanks for listening and wishing you all the best. Well, thanks for being with us on the Property Buyer podcast. We hope you enjoyed the show. If you have any questions or would like further information about buying property, please visit propertybuyer.com.au and we'd be delighted to help. We have loads of free resources and market updates and recent articles for you to explore. We look forward to joining you on another episode very soon. I'm Rich Harvey. Thanks for listening.